Why are electronically traded funds better than mutual funds? Which ETFs should I be buying now? Is now a good time to buy? Hang on.
This is not financial nor professional advice. This video is for entertainment only.
Hey everyone, electronically traded funds, ETFs, give you instant diversification and are relatively safe. Unlike mutual funds, you can trade them during any time of the day. With mutual funds, you are forced to both buy and sell at the price that the stock ends at that day. Okay, so there's no intraday trading with mutual funds. It's the price at the end of the day is what you will get, both buying it and selling it, which is not really all that safe if the market decides to take a sudden dive. You want to be able to get out of it quickly. And also if the market has an explosive up day, you generally want to get in before that explosion is over. You want to get in on the uptrend. And electronically traded funds allow you to do that. By far, the most popular ETF is VOO, which is the Vanguard S&P 500 ETF. This ETF has outperformed actively managed funds at least 60% of the time. It represents the 500 best and most prosperous companies in the United States. It's a favorite. It should be a staple in your investing. Some people, that's all they do is VOO because they know they are investing in the 500 best companies in the United States. Looking at the 5-year chart for VOO, you can see that it's usually been in an uptrend, but this year has been a vicious bear market and is down almost 20%. So it's usually doing better than this, but this indicates it might be getting close to time to buy, because when you're in a bear market, the turnarounds can be sudden and they can be intense. And so especially with the price to earnings being only about 13, the usual price to earnings is 15. So a lower price to earnings means that you're getting a good price. So it's near the bottom if it's not at the bottom. And it might be wise to dollar cost average into this so that you don't end up putting too much money in either at before it's reached the bottom. So you might want to dollar cost average a little bit into this. Some people do this religiously. They pick a day of the month, and every month on that day they put $100 into it, and eventually over time you will be buying shares at a lower price sometimes and at a higher price sometimes, but you get more shares when you buy at a lower price, so it averages out in your favor. With the vicious bear market we've been through, I find myself being more inclined towards conservative sorts of ETFs. And the Vanguard High Dividend Yield ETF fits that bill. It pays a dividend around 3%, which is pretty strong. So these tend to be large blue chip sorts of companies, so they tend to be less volatile. And with the dividend, you're getting some steady income. So I think it's best in these times to be conservative. Looking at the 5-year chart, VYO has held up pretty good. You may also wonder why I'm picking Vanguard funds so much, and it's because Vanguard usually has lower expenses, so you have less management fees being taken out of your ETF. And if you're saving for retirement, that's especially important. And over the years, it adds up to be quite a bit. But it's survived two crashes in the last 5 years relatively well. And this year, for example, uh, let's say it's a bear market. Let's say it should be down 20% and it's only down 3%. And like I say, the market will turn and will turn bullish at some point, and we want to be preparing for that. I've owned Vanguard Healthcare Fund for many times over the years, and it's always been a good performer for me. Its symbol is VHT. As we look at the 5-year chart, you can see that it's gone up well. And this year it's down 10% when the overall market is down 20%. So we have a winner here. It's a long-term hold, I think. I think you're getting in on a good price now. The market could go lower, but I think a person could begin to accumulate this because we're getting near the bottom. XLI is the industrial sector of the S&P 500, and by its very nature, it tends to be conservative. But in the last month, they have really come to life, and it's gone up about 12% in the last month. So I see this as a good conservative stock, a good conservative ETF that is just beating out the other sectors, many of the other sectors anyway. And in the last month, you can see, looking at the chart, that XLI has had a nice, smooth uh, uplift and is making over 12%. So this is one that we want to own for now and probably for the fairly long-term future. Another conservative fund that's sure to benefit from the infrastructure bill is PAVE, P-A-V-E. It's like you pave the highway, right? Uh, this is a company or a stock that started in 2017 because of our crumbling infrastructure, and they realized that the government would sooner or later do something about our bad infrastructure. And their dream came true this year when Biden managed to get the infrastructure bill passed, which puts out massive amounts of money for the next 10 years. So PAVE, P-A-V-E, is 70% uh, industrial firms and power management firms and steel makers, things like that. They also have a lot of construction firms. Materials make up about 20% of the fund. So this is something that was designed and is going to benefit strongly from the crumbling infrastructure finally getting fixed, thanks to Biden and Congress. As you look at this 5-year chart on PAVE, uh, one thing you'll notice is that it's gone up in recent years because of the infrastructure talk. And I expected to turn around once this bear market ends, which I think is not going to be too long into the future. But once interest rates start to stabilize, or at least aren't going up dramatically, I think we have a good chance of conservative funds like this doing very well. The thing to notice about that chart is the price to earnings is 2.68. Wow, is that low? You know, I think that means they're making a lot of money for the price that you're paying for it. So I think this will reward investors. At some point, you want exposure to smaller stocks also. And I like IWM, which is iShares Russell 2000 ETF. The Russell 2000 contains a lot of smaller stocks, and so that gives you exposure to that part of the market. Small stocks tend to be the first to go down when the market crashes, but they also tend to be the first to recover. And we're seeing some signs of recovery as it's gone up about 3.6% in the past month. So hopefully this is the beginning of a recovery. And in any case, if the market does recover significantly, they will benefit greatly. And you might want to start dollar cost averaging into IWM. And as we look at the 1 month chart of IWM, we can see signs that it's trying to take off, but it's really a good buy if the market is nearing the bottom and it's going to turn around. I would wait maybe for another 2 or 3% uptick before I bought it, just to be sure we are in an uptrend. But it's a good buy. It's 2.68 for price to earnings, which is outrageously low, especially for small stocks. Please smash the like button if this has been at all helpful, and subscribe if you haven't done that already. Hit the notification bell if you want to be notified of future videos. Good luck in all your investing. I think things are getting ready to turn around. I'm hoping that we're nearing the bottom of this endless pit market, what it's been this year. This has been some of the most difficult trading I've ever done in my life. I've gone from shorting to being bullish at times. And I vacillate between the two, and I find myself vacillating a little bit more towards wanting to be bullish, or at least holding off on being short, because I don't want to short when the VIX is less than 25. I don't want to short anything when the VIX is less than 25. And that's becoming sort of an ironclad rule in my own mind. So good luck to you all, and thank you.